Last week was our first playoff game, and my plaque psoriasis was so itchy under all my gear. Sometimes just thinking about scratching could take me out of the moment. And then my doctor told me I could get clearer skin with a pill called Otezla.
Otezla apremilast is a prescription medicine used to treat adult patients with plaque psoriasis for whom phototherapy or systemic therapy is appropriate. Otezla can help you get clearer skin after just 4 months.
Okay, ready for the next game. Talking to my doctor about a pill was a total game changer.
Don't use Otezla if you're allergic to it. Get medical help right away if you have trouble breathing or swallowing, swelling of the face, lips, tongue, throat, or arms. Severe diarrhea, nausea or vomiting, depression, suicidal thoughts, or weight loss can happen. Tell your doctor if any of these occur and if you have a history of depression or suicidal thoughts. Live in the moment. Ask your doctor about Otezla. Call 1-844-4-OTEZLA or visit Otezla.com for prescribing info about cost, and more.
Reality radio for a really great future. We're talking real money.
Today's theme is, what do you want from your investments? That is the theme of today's show. What is it that you want? We're talking real money on Talking Real Money, and I'm Real Money talk show host Don McDonald, along with Real Money talk show host Tom Cock, and we're talking real money with you. And we're going to actually have our first guest, real guest, because Paul was kind of a co-host.
Yeah, we don't really do the guest thing very often because
we don't do guests very often.
There's two huge egos already on this show. You add a third, it's impossible. So
it's exploding.
Yeah,
and the reason I'm having this guest is because I used to interview him years ago.
Well, we had him. I think we had him on our show on KVI as well.
Sound Investing.
Indeed, yeah,
yeah. And he used to work for Money Magazine, and he sent me his people sent me a note asking to have him on the show. And since Tom was going to go to hear a speech at the Museum of Air and Flight and Space
Museum
and
of
whatever,
Flight, you're right. Okay, keep going.
I don't know.
Yeah.
I thought, this would be a good time to have him on. And then Tom said, no, wait, this is going to be too good an interview.
There's certain things you don't miss. You know,
he goes, no. The Museum of Flight is good. It's all well and good, but no, I can't miss this interview. And let me just tell you, this is the show you don't want to leave. You don't want to leave this show. I have been doing research for this guest for I probably put in 8 or 10 hours straight of researching this guest.
He hasn't worked this hard on a single project since he tried for a pay raise. I mean, this is really something.
Well, that's true too.
Let's hope it works out better than the pay raise.
No,
but okay.
Actually, do you know what the other project is I worked harder than this on?
Yeah.
Do you know what that is?
Your marriage to Debbie?
Well, yeah, no, much harder. Okay. For Vestry,
that was too easy.
Book. The Better Retirement Guidebook.
That thing is awesome. That book is awesome.
I worked really hard on that book.
You know, in fairness, and it has not gotten the recognition I think it truly deserves. I'm not mocking you. I'm not mocking you.
That's why I'm giving it away.
I know.
Only to KVI listeners.
Right. If you call right now, you get a book, right?
No, not if they call right now.
I'm just kidding. Yeah.
No, what they can do is they can go to retirebetterbook.com. Retirebetterbook.
Don McDonald has a new website? That's a shocker there. That's hard to believe.
Well, it's because it's easier to remember, like Retire Better Book. Retirebetterbook.com. Go to retirebetterbook.com and fill out the little form. And let me tell you, we absolutely promise you, unless you say, please call me, because I need some help from an advisor,
we're not gonna bug
we will not call you. We will not call you. Okay?
Oh, well, that's not entirely true. That's not.
We will?
Yeah, we will. Because if you're a stock trader who's beating the market and you're going to show us that you have, we will call you.
We will have none of those. We will have none of that.
Well,
Mr.
but
Cox,
if you
none
do,
of that.
if we do, then we will call you. Yeah.
Okay.
Because the guy already said, the guy on the show a couple hours ago said, call me up. I'll show you. I'll show you how I beat the market.
Oh, yeah. Okay. Once again, Tom is doing what talk show hosts are never supposed to do.
I break every rule.
He's referring back to our other show on Como that we did prior to this. We had a guy who was very, very confident in his skills.
Indeed, he was, yes.
As a market trader.
Yeah.
Which we don't believe is possible.
It just really rankles me that what he said was, I know you guys. No, it really does. It's so irritating because what he said was, what he inferred. We didn't even infer it. He said, "I know you guys need to come on the air and talk about index funds for the public, but us smart people over there, we're trading stocks and we're getting rich, man. But you little people, you go ahead and use index funds." That's what he said, right? Isn't that what he said?
That's basically what he said.
And that's what the reason I hate that is because you in the audience believe that. Many of you do. I know it because I run into you. You think that there's some secret sauce. There's something that we're doing that you're not getting in on that making us rich, and you're not getting it. I got news for you, by the way. The only way we make money is working. There were people at my house today. They said, "You're going to work today?" I said, "Yeah, and I'm going tomorrow." "Really?" I said, "Yeah. I work. Yeah. That's how I make a living. There's no trick."
They actually have salves for that festering sore.
No, I mean that really does that.
Rankle. Rankle is Middle English derived from the French word rankle or festering sore.
Okay. Well, it is because I hate that because what you're really saying is I'm smarter than you and I know how to do this and you don't.
Wait.
That's what you're saying.
I have a BS in chemistry and I can recognize patterns. Well, wait a minute. What about the guy? Do you think the guy with the PhD in chemistry?
And you know how many PhDs are working on Wall Street now? There are, I'll bet, tens of thousands.
Oh, sure. Easily.
Hedge funds, mutual funds, all the major brokerages that are looking for patterns out of chaos that you can't find. That's crazy.
But now I want to give the phone number in case anybody wants to join us during our conversation.
Please.
Or call us with anything else when we're not talking to Jordan. We'll tell you about in a minute. 855-935-TALK is our phone number, 855-935-8255. But I want to go back to the original question with which I opened the hour.
What do I want from my investments?
What do most people want from their investment? I want to
make a lot of money.
This leads right into our guest.
I want to make a lot of money, and I don't want to take any risk.
Right.
Yeah. That's a no-brainer. Come on.
How many of you?
By the way, I want that from my relationships. I want that from my children. I want everything to go perfect, and I don't want any potential downside. None.
I was going to say, if you want a lot of money with no risk from your children, good luck.
I'm hoping, but
it works the other way.
Because people are always saying, you don't be a burden to your children when you're old. No, I'm going to be a tremendous burden. They've been a huge burden to me for years, so that's not a problem for me.
Payback is a biatch.
So anyway, yes, like everybody else, Don, I want to make a lot of money, and I don't want to take any risk to do it. Thank you.
Well, we're going to discuss that coming up.
Oh, okay. So there is a way. What you're telling me, there is a way?
Apparently, our guest thinks so. And just for, I just want to set this thing up.
Yeah, please.
This is a guy, he was a respected reporter for Money Magazine for many years. I had him on the show a lot. He wrote a book called Everyone's Money Book. It's about 45 inches thick.
Really?
It's like it's gigantic.
Do you still have it?
A copy of it?
You have it there?
I'm looking right
next to the Yes album there behind you or something, whatever that is. Or
I think what you're seeing is
like
Court of the Crimson King.
Yeah, I'm sure. It's something.
I do. Hold on.
You still have the book there? Okay, Don's going to go get that. I will mention the telephone number again, 855-935.
It was on my bookshelf.
Whoa, that is a big book. Wow.
Everyone's Money Book.
Look how handsome he is there.
By Jordan Goodman.
Yeah, no wonder he's so popular.
Everything you need to know about investing wisely, buying a home, financing college, minimizing taxes, planning retirement,
and much more. How many pages is that?
How
many pages is that? Looks like 300, 400, 500 pages? Yeah, that's humongous. No.
824.
Whoa. I think it's silly to write a book like that because how many people are actually going to go through 800 pages? Almost nobody.
Oh, and he wrote it when he's got the annual cost of fuel for your car.
Yeah.
Based on $1 to $1.50 a gallon.
Yeah, and I just paid $3.30 the other day. So
that kind of tells you how long ago that was written. Oh, now wait! I have some good news for everybody. This is good financial news.
Yeah,
this is great financial news.
So glad
because I do the financial reports in the morning on Como.
Yes, you do. You are there every day.
So I know everything about oil prices now. Oil went down like crazy last week.
I saw that. It really tumbled. So that will be reflected in the price sometime in the fall of 2020.
Actually, they said this week.
Oh, baloney. That
They said
stuff,
that.
no, they always...
After Memorial Day weekend's over.
Oh, yeah, after everybody stops driving. Sure, no problem.
Exactly.
Yeah, okay, that makes sense. Don doesn't care because he's got a car that uses 1 gallon a year. So
well, I have an electric car. It uses no gallons a year.
Oh, pardon me. And then you have the other one that uses almost none.
It uses gas. I just never drive it because my commute is
short.
Down the hall and to the right.
Oh, and by the way, just for those of you who don't know that my kids do listen. They wrote and said, "Burden, huh?" Yeah. Anyway,
is that your daughter?
Yes, she did.
She listens to the show,
so you can count on the fact that in about 20 years, when I need her help, I'll be getting help. All right.
When
it
won't
be the type I want.
All of my kids are in their 20s or 30s.
Yeah.
Actually need what we talk about on this show.
Uh-huh.
And not a one of them listens.
Well, at least they know you do a show. I think I've talked about it at home. My wife doesn't even know I've got one.
Yeah,
she thinks I'm off drinking beer, watching soccer on Saturdays or something. So
she's out cooking pizza.
Yeah, doesn't really care. But anyway, all right.
So anyway, we've got the author of Everyone's Money book coming up
Good
on
Lord.
the show, and the reason I talk about the what everybody wants is because Jordan is going to tell us about a couple of investments that he has been pushing that promised 8% per year returns. And as a matter of fact, here's a direct quote from the email he sent me. This is a direct quote from him. Quote, instead of keeping your money in the bank earning 0%.
Which isn't quite true, by the way, but okay.
This
you don't get zero.
Fund would be a suitable alternative that pays 8% a year in monthly checks. Now, we're going to ask him about that because let me tell you, if you could get an 8% return with the safety of a bank, you would be a fool not to take it.
Well, again, if that were true, there would be no capital markets. No, I mean, there would seriously be, because no one would invest in stocks. Why would you? No one would invest in puny government bonds that are paying like 2.5 to 3%.
I mean, look back at the almost 100-year track record for a diversified portfolio of U.S. stocks. The average annual return is about 9% a year, and you had to suffer through some pretty horrible times to get that.
Yeah.
If you could have gotten 8% per year without any volatility, why would you buy stocks? This is like my argument against those idiots who sell indexed annuities, who say, we can get you the return of the stock market with none of the risk. Now, let me just tell all of you who sell those, you're liars. Call me and refute that. Call me and show me you're not a liar. Show me where these things actually get the return of the stock market, and I will retract that. Not only will I retract that, I will put you on the show and let you plug your product.
Wow. Okay.
So here's the number, 855-935-TALK. If you sell an indexed annuity and you honestly believe that you can show me how we can get the return of the stock market with no risk whatsoever. Now, the key phrase is the return of the stock market. You're always saying it's the S&P 500. Yeah. How can you give people the return of the S&P 500 with no risk? The reality is you can't. 855-935-TALK. Our guest, Jordan Goodman, coming up after the break. Don't leave us now.
Tom and Don are talking real money.
If you're sick of investing through an insurance agent or a stockbroker and you're in the market for a fee-only advisor who charges truly low fees and uses a scientific approach to building portfolios for your risk tolerance and need, you should check out Vestory. Tom and I started this firm, and it is devoted to educating everyone, total transparency, clarity, low fees, and great service. If you're looking for an advisor, you ought to at least take a look at us at Vestory.com. That's Vestory.com. Or give us a call, 800-386-3004.
Your guides to a really great financial future. Tom and Don are talking real money.
Once again, the number for Talking Real Money is 855-935-8255. That actually spells talk. I'm Don, along with Mr. Rankle over there at the other mic. I think that's your new name. I'm going to just call you Mr. Rankle.
Better than Mr. Wrinkle, I'll take it. So,
yeah,
okay.
Yeah, Mr. Rankle.
Yep.
Mr. Oozing Sore. 855-935-TALK is our phone number. Now, 1988, taking you back in time. Don McDonald started hosting a show on the Business Radio Network called The Ways and Means Committee, which changed its name shortly thereafter to The Don McDonald Show. And I was on all over the country talking to people.
Including here, by the way, where I was programming a radio station and put the Business Radio Network on the air, and your show was there. 1988.
That's how Tom and I ran into each other a long time ago. Well, one of the other people I ran into was a reporter for Money Magazine by the name of Jordan Goodman, who went on to write this really, really gigantic book that I still have a copy of. Did you sign it? Oh, Jordan did. You signed it. Jordan Goodman, welcome to Talking Real Money.
Great to be with you, Don and Tom.
You know what Jordan actually said? I don't know if he's going to agree with this after we're done, but he says,
he said, Don, buzz off.
To Don, the financial talk show host with the most integrity. Thanks, Jordan.
Whoa, that's nice.
That's
nice.
true.
Well, that's nice.
true.
Yeah. All right.
And you've been doing this for many, many years. We've both been doing this for many, many years, and glad to be back with you. It's been a long time.
And you look so darn handsome on that cover. I think I'd put that in place of your picture on the website there, Jordan. That
was when gas was $1.50 a gallon, dude.
Well, things have changed a little bit, but not that much.
They're up from $1.50 a gallon.
That's true. It's about doubled, $3 a gallon, something like that.
Yeah,
but who's counting?
Hey, when I got the note that you were available to come on the show, I was really intrigued in large part because you were featured in a story in the Wall Street Journal about a bridge loan company by the name of Woodbridge.
Woodbridge Wealth, correct.
Woodbridge Wealth. And the Wall Street Journal mentioned that you, as a matter of fact, there was some guy in Colorado who said that he believed that you said that Woodbridge Wealth offered offered safety and security. And a big honking 8% return.
I mean, I don't think I ever said safe, but secured, because it's secured by actual real estate. And basically, what a bridge loan is, these are commercial bridge loans, or it's often called hard money lending, is a first lien position on a specific piece of real estate being used for construction or improving the real estate somehow. They pay the interest, and then once the construction is done, they pay the money back. And Woodbridge had been doing this for many, many years successfully. I started telling people about it in 2014, and it worked perfectly for thousands of investors with literally hundreds of millions of dollars. Everybody got paid exactly on time, both interest and principal as due, until December 4th, 2017, a day that shall live in infamy, when completely out of the blue, they surprised everybody, including me, and went for a Chapter 11 restructuring, which is now in the process of kind of going through that. So it worked perfectly for over 4 years, but then it didn't.
Well, now, but I just finished, after a long morning of research, reading and then rereading the Securities and Exchange Commission complaint against Woodbridge. And the Securities and Exchange Commission claims that Woodbridge and its owner, Robert Shapiro, or its principal, Robert Shapiro, used $328 million of new investors' money to repay old investors, and that they spent $172 million on operating expenses. They paid $64 million in commissions, and he spent $21 million personally on quote extravagant personal expenditures. And they went on in this complaint to say that he only lent out enough money to truly unaffiliated borrowers to generate $13 million over that entire 4.5 year period in interest income. And they list a number of companies, affiliated companies that Shapiro owned or had an interest in, that all got loans with no interest from the fund. So
that suit was filed in December. Right. Shapiro was completely out of it at this point. He was the one running the whole thing, and that has not moved at all they've alleged all these kind of things. All I know is I had no idea of any of that kind of stuff. But people were getting paid on time.
Reading this, it looks like a bad deal that Shapiro was playing really fast and loose with money. As a matter of fact, in an SEC interview, he pled the fifth multiple times.
Well, yeah. I mean, you have the right to plead the fifth. I don't think it was great that he did that, but he did. All I know is they had a separate company, which was called Riverdale Funding, which brought in tons of third-party borrowers, not just Woodbridge-only deals. Okay,
right, but the SEC is saying they only brought in enough third-party borrowers over 4.5 years. It's a $1.2 billion fund that over 4.5 years only brought in from third-party borrowers $13 million in interest. That's 1%.
Doesn't make any sense to me. I talked to the people at the time at Riverdale.
Have you read the complaint?
They were talking about. I have. I don't believe it. I just don't think it's right.
I guess, and for me, Jordan, I guess the question is, what were people promised? In other words, what were people thinking they were going to get or were getting, as you said, for 4 years?
What they were getting was a first lien position on a specific piece of real estate, which was completely identified. They knew exactly where it was. All the legal paperwork was done where they were getting a first lien position registered in the county courthouse on a specific piece. And if it was a 1-year loan, which most of them were, they would be getting a 6% interest rate. Some of them were a little bit longer, like 2 years, they'd get like 8%. And they, in fact, were getting the payments on time. And then it would come due in a year, and they would renew it. And most people renewed because they were super, super happy getting all this money, as opposed to keeping in the bank getting zero, basically.
But like most Ponzi schemes, like most Ponzi schemes, what the SEC is saying from their investigation, and by the way, the Wall Street Journal also did a separate investigation where they found that the vast majority of the money went into Shapiro-backed ventures that were buying luxury houses in California and around the country. The SEC is saying that the $328 million that was paid out as principal and interest payments to investors was in fact just new money coming in. It was not actual income from the portfolio. So yes, people were getting it just like they were getting paid by Bernie Madoff before his deal unraveled.
Well, the difference between this and Madoff, I think, is a huge difference. Madoff basically was shuffling paper around, and he was taking money from new people and paying the old people. All the trades that he said he was doing, in his case, he was saying there's writing options on S&P contracts, never happened. There were no trades at all. The whole $50 billion thing that Madoff had was a complete fiction. There was no transactions going on. Here, clearly there were actual transactions going on.
Right. The SEC is not denying that there were actual transactions, but they listed a list of, oh my gosh, it's 144 companies with whom Shapiro had an interest, who borrowed money from the fund and yet never paid any interest on their notes. 144.
So what's happening right now is these actual properties that are really out there, and one of the most famous.
Yeah, there are properties there. Yes, yeah, they're there.
Yeah, they're real properties down.
Oh no, I looked them up. Alridge. Yeah, there's a lot of them.
I mean, Alwood actually he bought for $90 million. He's been renovating. I think it's on sale for $180 million, something like that. It was actually the place.
Wait. Now are you calling the Wall Street Journal specifically addressed that property, and they said no renovations were done on the property. They put it up for sale for $180 million with no renovations. Now that's from two reporters at the Wall Street Journal, and you were a reporter.
They have a picture of it.
They do their homework.
In the journal. It's a beautiful place. Maybe it didn't need renovations.
Well, that's what they said, though. They said they did no renovations on it. He bought it for $90 and put it on the market for $180, but he hasn't gotten any bids anywhere near that amount, or they haven't. Now it's under a receiver, and the receiver, it's not receiver. It's I'm trying to remember the name.
Well, under the court, the bankruptcy court, basically.
Right, and they expect, because they do have properties, they expect to get 50, 60, 70 cents on the dollar. But the fact remains, though, that it appears, at least it appears allegedly, based on this very long allegation, that you got involved with a guy who really wasn't behaving on the up and up. And isn't that something that can happen anytime you have a deal that claims higher returns with lower risk?
It can happen. I agree with you. It's definitely a risk. I mean, I'll just tell you, Don, we've known each other for a long time. I checked this out as absolutely carefully as I could. I went and visited him, saw his operation, as carefully as I possibly could. And that was again, early 2014, and saw all the properties and just followed the whole thing as carefully as I could. And all I could see was what was actually happening, where people were getting paid interest and principal on time. Projects would come due, they'd get their principal back, and a lot of people would test it, and they would get their principal back and then go back into another project. My understanding of what the problem was is that the SEC said these bridge loans were securities, where in fact I think they were not securities. And Shapiro and Woodbridge battled against the SEC, spent a huge amount of money on lawyers to kind of battle that, and ultimately filed because they gave up. They just couldn't battle them again.
Yeah, and I read your note
all over the country.
Yeah, I read your note about that. I mean, I think for me, as a guy who's been around this for a long time, radio, TV, managing money, when somebody says 6% in a very low interest rate environment, and
or 8,
or whatever, anything that's above market like returns, I always think if it were true, there would be no securities market for stocks or bonds because everybody would just put money in something that pays 6 or 8%. So then I think, well, what gives you? It doesn't pass the smell test for me. Why do we think you're smarter or Shapiro is smarter than the rest of the world? That's the issue we have with the whole thing.
All right. Well, Shapiro, first of all, had about 40 years of experience in the real estate market. He was a very smart guy. He basically did this in 2 locations, the L.A. area and the Denver area, which he knew extremely well. He had a big house in Aspen, and he lived in L.A., so he knew those 2 markets extremely well. So he did bring a lot of knowledge of the market that most people would not have, and these were secured actual properties. And all I can tell you is people actually got paid. I don't think they were getting paid from new money coming in. We'll have to see what happens to that SEC suit. Okay. That was filed, I think it was December 20th, and nothing has happened to it since, as far as I know. And
we're going to take a break for news. The number here. Hang on for a second with us. We're going to take a break for news. We'll be back with Jordan Goodman on Talking Real Money. Stay with us. 855-935-TALK is our phone number. That's 855-935-8255.
Tom and Don are talking real money.
If you're looking for a nice short podcast to tide you over between episodes of Talking Real Money, check out Money 30. Money 30 podcasts are between 2 and 4 minutes long, and they're available at every major podcast service, including Apple Podcasts, or you can visit money30.com.
For your real life and real future, Tom and Don are talking real money.
Welcome back to the program. I'm Don, that's Tom, and we are talking with Jordan Goodman, the man who wrote the Everyone's Money book.
The Bible. I mean, look at the size of that thing.
No, it's actually thicker than the Bible.
It is. There's more words there.
There's more. It's thicker. It beats the Bible.
Is better too.
Exactly.
Yeah, and the typeface is actually about the same size. So he's not hedging by just
the Bible
increasing.
Smaller typeface, actually, I must say.
All right, and cheerier, hopefully. Too. So.
All right, let's talk about something different. Let's talk about what people should be investing in now. Now you had this experience. It didn't work out well. You got some bad press for it. So what is it? I mean, we talk about what people should be doing now. There was a time when I believed in active management, and then I stopped. I got over it. What do you believe people should be doing with their money now? How should they be investing?
For income, there's things for growth, but let's talk about income, because it's a big problem for people. People have capital, and if they put it in the bank, they're going to be earning less than 1%, in many cases 0, in savings accounts, checking accounts, CDs, those kind of things, pretty much 0. And then if you go to traditional, long bonds, you're going to get 2.9% today, but I think rates are going to rise further, and therefore you have more capital loss, not only in bonds, but what I call bond surrogates, things like utilities, real estate investment trusts, master limited partnerships, they all trade along with bonds. And when interest rates rise, they're going to lose principal, as they have, and I think will continue to. So that's not a great place to get income today. So I'll tell you what I'm involved with, which I think is a good solution for people, which is an SEC-registered product. Doesn't have the problem that Woodbridge had, which was not SEC. Is what's called secured real estate funds, and that's a way of getting an 8% yield over a one-year time frame. You can get monthly checks if you like. You can reinvest them if you like. They are doing short-term loans to commercial projects, but it's all gone through the SEC. Now, in 2012, Congress passed a law called the Jobs Act of 2012, which authorized what are called Regulation A-plus funds, or Reg A-plus funds. That's the kind of technical term. They're actually called crowdfunding. That's what people call them informally. And that's what this is. These were starting to be approved by the SEC in 2016, so it's been around for about 2 years, and has actually been producing returns of 8%. Actually,
I thought it started in. I thought it started in 20. I was looking at the offering circular. It said it started in 17.
So there was a kind of a sister fund, I guess you'd say, which launched in April 2016. And then that was one of the old 405D programs. And then it was going through the SEC procedure. It was approved by the SEC. I think official date was October 2017. And so they kind of rolled the old one into the new one. So it's the same basic thing. It just had to go through. It took over a year to go through that SEC process, actually.
With an 8% promise, it sounds, though, like we're going from frying pan to the fire. It sounds like the same kind of a thing where an 8% return can certainly happen. But what are the risks involved with getting that kind of return?
Sure. So there are risks with real estate, and obviously this is not guaranteed or risk-free, anything like that. You can't say anything like that at all. But it's a widely diversified portfolio, and what they do, the ways that they mitigate the risk, it's not that there's no risk, but they mitigate the risks by diversifying geographically. It's like 30 different states. It's also diversified by type. So there's many different commercial types. There's assisted living. There's student housing. There are parking lots. There are apartment buildings. There are medical offices. So it's diversified that way. And the maximum they lend on a particular piece of property is 70% of the value of the property. So the builder-developer always
has that's the improved value, though, right, Jordan?
The improved value. That is correct.
Yeah, not the current value. For example, you buy a falling down building that's worth $500,000, but you could buy 70% of what you think the $1 million value you guess it will be. Correct.
That is correct. But I mean, they're not buying falling down buildings. They're buying things that need to be improved in various ways. But they do an appraisal. And they say once the construction is done, and they work with people who've done this many, many times, correct, they are lending against what the value of it's going to be once the project is completed, which is typically going to take about a year.
Okay, so I got to ask you, though, I got to ask you here. So what happens to the money when the real estate projects go underwater? Do you still get the safe 8% return?
Yes, you do. I mean,
so where does that come from then?
Let's take the worst case scenario, which the builder-developer defaults or doesn't finish the project. Okay. What they will do is they will take over the project and complete it. I mean, that's the way they've done this many, many times. The management team behind this has been doing this for 30 years, and so in a case like that, they would actually take it over. Now, remember, they've lent 70% of improved value. So once it's completed, if they sell it at 100% of approved value, they're going to have a big profit to distribute to the investors that way. So,
but let's say
they've done this a long, long time to mitigate.
I get that, but the thing I want to talk about what the real though potential risk is. Isn't there the risk that this could be like in a 2008 on steroids real estate market that hit more than just Vegas and Phoenix and Florida?
Yes.
What happens if these projects decline 50 or 60 or 70% in value and there's no demand for that improvement anymore in the marketplace?
It could happen, highly unlikely, particularly in the market today where it's the opposite. I mean, in Seattle, there's a shortage of housing and shortage of space, not the opposite. But, I mean, it could happen. It's just, even in 2008, commercial properties didn't go down at all as much as residential properties. And I mean, yeah, anything could happen. You know, the world could get hit by a meteor or something. But the actual returns that they've earned, even through 2008, I've asked them about this. They said commercial properties went down 5 to 10%, something like that. And part of it is picking the right properties. They picked them in markets that are doing very well and have that.
But that's what mutual fund managers say. That mutual fund managers say the trick is picking the right stock. But according to Spiva, 85% of the large cap growth funds over 5 years don't beat the index.
Right.
They claim they're good at picking stocks, but then they stink at it.
I would agree with you. I think index fund beats an awful lot of active management at much lower fees. But this is a different animal completely. These are people who've done this very experienced. And the other thing they do that's kind of unusual is what they call collaborative lending. They're like a partner to the builder developer, and they've done this again for many, many years. And so as a result of that, when the building is sold, ultimately they share some of the profits with the fund, and the fund shareholders get 80% of those profits.
Okay.
Now, is this in the book somewhere? I got to read the book more carefully.
No, this is not in the book.
Okay, I got to read the book more carefully.
All right. Here's the big question, though, Jordan. And again, you said we've known each other for a long time. I totally respected your work at Money. We've talked about a lot of interesting, solid kinds of things. Here's my big question for you right now. Why are you plugging things like this and precious metals? Why?
I'm not plugging precious metals.
Yes, you are on your website. On your website, you only have three things. You have this product, a precious metals company, and one investment advisor that you think is any good.
The precious metals is something called the Hard Assets Alliance. I'm saying if people want to buy gold or silver, that is the best way to do it because it's a competitive marketplace. It's not just one particular place. So
I guess the question I'm getting to is how well compensated are you by these various organizations that you claim are the right investment for people? Do you have a vested interest in saying this?
On the secured real estate fund, I'm on the board. Absolutely. So I mean, but I'm not getting commissions or anything like that. But I'm on the board.
Did you get paid by Woodbridge?
I know these people, and they've had a great track record. And it's helping a lot of people, Don. I mean,
did you get paid by Woodbridge?
I did. I'm not saying I didn't. This is what's called capitalism. It's actually a very good thing.
If I got paid by Vanguard to say Vanguard funds are the best funds, I would feel bad saying that. Yeah. I wouldn't feel right about it.
I helped thousands of people improve their lives by getting income that they would not get otherwise, and for over 4.5 years. And I feel very good about that, and I feel very bad that this was what happened because the SEC went after them, in what I consider a witch hunt, basically. Because I don't think they want a Ponzi scheme.
We've attended financial fests in Phoenix together, and there are a couple of guys who attended financial fests down there that were speakers all the time for Ron, and both of these guys were censured and barred by the SEC. And it's funny, both of them said that it was due to an SEC witch hunt. It's kind of like the guys in jail.
Here's my other take on that too. Investment News had a very critical piece on Woodbridge. They're generally pretty friendly to the industry. The Wall Street Journal, a different matter. SEC, I don't know their investigative methods. But when Investment News beats it up, then I got to start thinking, maybe this doesn't smell so good.
They only beat it up, Tom, after things went wrong. Okay, when things are going fine, everybody's getting paid on time. Nobody had any complaints. None, anywhere.
Well,
okay, they had thousands of investors being paid on time, interest and principal, for many, many years. Nobody complained until the SEC went after them. And the core issue is, are these securities? Okay.
No, that is not the core issue.
That's not even the point of the SEC's claim. I read the entire complaint, and it's not their complaint is not whether or not they're securities. They call it in their complaint a Ponzi scheme, a blatant Ponzi scheme. And if what they say is true, and he used $326 million that wasn't derived from the sale or income from properties in the portfolio to pay investors back, then in fact it meets the definition of a Ponzi scheme. If he was using the fund's assets to pay a return to his investors, that's a Ponzi scheme. It hasn't been proven yet. It hasn't been proven.
I don't think he was, but if that's proven, which it has not been proven, that would be a Ponzi scheme. I agree.
Now, let me ask you here. I said I wasn't going to go back to Woodbridge, but I'm going to go back to it one more time. Let's assume for a moment it turns out to be a Ponzi scheme. and you were recommending a Ponzi scheme and getting paid for it, would you disgorge the money you made back to the investors who lost money because you recommended it to them?
Yes, I'd do that because I didn't think there was anything wrong. I did as much due diligence as I possibly could. And as I said, people were actually getting, good returns for many, many years. And so I did as much due diligence as I possibly could. And
understand.
I was not happy when I
got to tell you, I'd feel terrible. If I got paid to advise suggest something to my listeners and it ended up being a Ponzi scheme, I'd be all over trying to give back any money I made off of it. I made any money.
And
Jordan,
I think
thanks.
They are going to get the money back.
Jordan is America's money answer man, moneyanswers.com, and thanks so much for being with us. We'll be back after this.
Tom and Don are talking real money.
All right, let's get this break out of the way really quickly. If you're looking for an investment advisor, you need a fee-only, 100% fiduciary, low-cost, science-based advisor. And that describes Vestory. If you'd like to learn more about us, it's really easy. Go to Vestory.com, Vestory.com, or give us a call at 800-386-3004, 800-386-3004. There, that wasn't so bad.
Your guides to a really great financial future. Tom and Don are talking real money.
Oh, I'm a capitalist, but I don't believe capitalism is a license to say anything to make a buck. Am I?
That's not what you're accusing Jordan of. I don't think.
He said it's capitalism. He goes, this is just capitalism.
Yeah, I mean, he was a bit of an apologist for the fact that I've given people really great advice for 40 years, and now I'm doing this to make money. Okay, yeah, that's... By the way,
I've given people really good advice for over...
So they could say the same thing about you because...
I know, and now I have a company.
Yeah,
I am.
Firm, and we manage money, we get paid for it.
The difference is I don't sit here flogging my firm all day.
Yeah, I mean, we do flog what we believe, though. We do believe in getting market-like returns using index funds. We do believe you use managed proper those things. We do, and we promote that. Yeah,
we do. We promote that.
So yeah, I mean, everybody's got something to sell. I mean, that's what he's saying. Yeah, there's a capitalism.
And I agree with that. Everybody's got something to sell.
My problem with it is still, in my heart of hearts, I just don't believe you can get 8% a year. With any sort of safety.
Degree of safety.
You can't because it just doesn't. Again, if it were true, as I said, there would be no other investments because all of this, there are really smart people that study all this. You know that because we had
the average annual return for the entire U.S. stock market dating back to 1926 is about 9% per year.
And you had to take a ton of volatility along the way to make that. You didn't every year get a check for 9% of your money. It didn't happen.
You suffered through huge declines to get that.
And what Jordan is really saying is, yeah, but I've looked into these things. I studied them. I know them. Except that, as he said, I woke up on December 4th of last year and found out I didn't know. That's where I struggle. So I just think he's saying la and holding his fingers in his ears and hoping everything works out. And maybe it will this time.
And then that's the thing. Sheer luck would say everyone, and that's why a lot of these partnerships do work, or they work for a while.
Yeah, right.
As you said during the break, we were talking about real estate in Phoenix or real estate in Seattle.
Yeah.
It goes up until it doesn't.
Right. I mean, you pointed out in the ad correctly, Florida, Arizona, and I'm missing it.
Las Vegas, Nevada.
It was easy. You buy something, you flip it, do whatever, you make a quick buck. Until 2007 came along or 2008, and then it all stopped. I think that's coming here, and I'll tell you why. Because it is so parabolic right now. The increases, the fact that we're leading the country month after month after month after month, that prices honestly are insanely higher than they were even as recently as 2 or 3 years ago. At some point, that is not sustained. That kind of increase is not sustainable. It just
know what's sad, and I kind of said it. I mean, I respected what the advice that Jordan Goodman gave for so many years in Money Magazine because it was balanced and it was well thought out, it was well researched, and it wasn't based on any personal gain.
Yeah, that's true.
And it kind of bothers me to see that change.
You know, I mean, the reality
Makes me sad.
Well, he shouldn't be holding himself out as America's money master, whatever it is anymore. I honestly,
what the name is now.
No, I mean, he shouldn't be, because he's not. He is pitching a product that he, in some ways, believes is better than just doing the boring index, stocks, bonds, etc. I mean, that's what he's saying, really, at the end of the day. And it's certainly not journalism, because you're getting paid to say it.
Okay, his website was moneyanswers.com. I messed it up. Moneyanswers.com. But he does. He calls himself America's money answers man.
Yeah, that's...
and it implies a certain level of
independence.
Distance.
Yeah,
independence.
Right, yeah, that's true. And he's not that. So that's too bad. The problem is, though, as you have pointed out, the number of those people are getting smaller and smaller and smaller, because
there's no money in it.
There's no money in it. I mean, you can't make a decent living. I mean, how much are the reporters at Money Magazine making?
Oh, the two that are left?
Yeah, I mean, not right.
How many? There are not very many left.
And
no, they're not.
The people writing at CNBC,
as a matter of fact,
et cetera, and they're not making
most of the writers now for Forbes are all independents. They're the writers for Forbes. There was another one that had all independent writers.
I mean,
most of them
the great writing, I think, in this. I read, as you know, I do read the Wall Street Journal every day, and Bloomberg. I think Bloomberg is phenomenal. You really want to get into things and get into depth.
Pockets.
Yeah, they got a lot of money, and they can afford not to. The magazine doesn't have to make money. I mean, all these things in total probably do. But I mean, that's the problem, right?
I was in a similar boat to Jordan.
I know.
You know, I was hosting a show. I was making six figures for hosting a show, just barely. I was making I was making $96,000 when I left. I was making almost six figures.
Yeah.
And I was a good job. I gave advice that I think was totally uncolored.
I agree.
Totally uncolored. I believed wrong in a lot of cases, but it wasn't
that
colored
happened,
by...
But you weren't getting paid to say something.
I wasn't getting paid.
Yeah.
And when that job ended completely, I sold antique maps.
Well, and you should have gone to work for the next host, because you would have been great with helpful hints from Heloise and Don. Isn't that who took over your show?
If Jordan had gone into like some other business, I would be more.
You have.
Respectful.
I mean, I will say this about you: have been very clear from the moment I met you. I can't be bought.
No, I had a guy.
No, you even said that when we first, because there was people that would have, and Paul Merriman wanted you to. I mean, all these people along the way. He said, I'm just not going to do that. Good for you.
I don't care about money. I had a guy in South Florida. I think his last name was Bruno or something.
Say yes Bruno. To him, by the way. Yeah.
Oh, and he scared me. I swear he looked like Mob. Big guy, kind of talk like this. And this guy had all of these plans. He wanted to hook up. This is when I was at Disney. Yep. Wanted to hook up with me. He could make a lot of money pushing his products. He was in the investment advice business, you know. And, we could hook up, make a lot of money. And I went, Frank, unless you can show me empirical data proving what you're doing actually can, will, and should work, I don't care how much money. And he was going to make me a multimillionaire. Probably would have, too.
Yep.
I don't know where he ended up. I can't remember.
I mean, that was
name.
interesting that Jordan said he would give the money back if it turned out to be a Ponzi scheme. That was interesting.
I think that's awesome.
Yeah, I do, too.
Actually, I was shocked.
Will he? He got to be there and watch, I want to see it.
Well, we have it on tape now.
Yeah, okay. That's going to go a long way. By the way, and you know these things take forever. This is part of the process.
This is going to wind through the courts
my goodness.
Forever.
And of course, the defense is always the same. Mm-hmm. SEC witch hunt. They always say that. It's so old, but
my guess is this SEC complaint will end up being settled with a huge, big, gigantic fine without
and they got to get through the bankruptcy, find out what's really there.
But if it is in fact a Ponzi scheme, and there is a grand jury that believes that was then he could spend. Shapiro could do some time.
Oh, I think unquestioned. I mean, the fact that you took $21 million out of the deal and spent it on yourself, that doesn't look good.
They actually have a list. This is fascinating.
I mean, by the way, you said private jets. He did not own a private jet. He was just flying on rented private jets.
He was renting.
There's a big difference there, mister. Come on.
To the tune of $600,000 in private jet flights.
That's barely gets you from here to Toledo every weekend. Come on, that's nothing. Come on.
You know, it's more than the Secretary of the Environmental Protection
EPA,
Agency.
Yeah, I got it. Yeah.
So it's, okay, wait. Here's what he spent.
Yeah.
From the $200,000 at Four Seasons hotels.
Okay, well that's a weekend at a nice spot.
This is out of his fund. $34,000 for limo service.
Okay.
$1.6 million for furniture for his house.
That's a big place, by the way. You got to be able to have a lot of room.
$1.4 million at stores like Louis Vuitton and Chanel.
But at least he spent more on the furniture than the purses. Okay, that's
now
all right.
This one maybe $700,000 on meals and entertainment. You're a big eater, big drinker.
Nice wines.
$400,000 on jewelry.
Darn, I feel bad. Only got one piece.
$308,000 on wine. Oh wait, I was wrong about
the wine is in addition to the meals. Okay,
I was wrong about the charter planes. I'm sorry, it was $3.1 million to charter planes.
Yeah, well,
$1.2 million in alimony came out of the fund.
My ex-wife's going to feel bad about how little money she got now when she hears
apparently
that, so.
$340,000 in cars. And $130,000 to the country club.
I've always got a question about that. How many cars can you drive at one time? Or is that one car? I don't know.
It could be one car. It could be a Rolls.
That's true.
And $1 million in rare coins to give to clients.
Oh, yeah. Okay. Yeah.
That's, of course, a marketing expense there.
Yeah, because you got to give them
and
that.
What were the commissions on this fund? And by the way, the one Jordan's plugging.
It's 10%, right? Or 9%?
8%.
Yeah,
9%. 9%.
I just really struggle with anything that pays that. Do you think the person selling that product is incentivized to sell it to you? Oh, really incentivized at 9%. That's a lot of pressure.
I went through the offering statement, the offering circular on Jordan's thing, secure real estate investment thing. And after all the expenses, they would have the fees to the managers,
the whole bit,
the 8% they're going to pay out, the bonuses the manager gets, all of this. Their returns would have to be in the range of 10.5% to 12% per year
to make it up,
to break even. 10.5% to 12%. How many people are going to borrow money at 12% on secured real estate? Only people with shady backgrounds or bad real estate. Hey, check us out, TalkingRealMoney.com, TalkingRealMoney.com.
Tom and Don are talking real money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.